All right, stocks finished today slightly positive in a very small range, which is very rare for a CPI day. In the past, CPI days have been pretty strong, good, strong moves to the upside. Not the case, mostly to the upside, but not the case today. A little bit to the upside, but there's a big day tomorrow due, and especially in the morning, and that's kind of what I believe the market is kind of prepping for and waiting for is what can happen with retail sales and pretty much the state of the consumer between retail sales and the Walmart earnings report. So we were in kind of limbo today. So we talked about this kind of inflection point that we were at yesterday in last night's market outlook video. Today, despite the CPI report, we did not get a move, a direction one way or the other, and ended up with more of a limbo, small range limbo day today. We'll take a look at that in context of the discussion we've been having, our expectations of what the markets can do. Again, whether or not, how will it respond? What is it set up for? What kind of response is the market set up for going into tomorrow? And then what can we expect to see based off of the reaction the market gets tomorrow? What kind of move up or down? What kind of gaps or gap fills can we expect to see, and how will that impact our expectations? So we take a look at all of that. Take a look at what's driving the price action today. As you see, yields continuing to move lower. As inflation was relatively soft, met expectations, but still relatively soft, bringing the rate cut odds up. Not necessarily high for September for a 50 basis point cut, but by the end of the year, there's relatively high odds, around 80% for a 50 basis point cut at one of the three meetings that we have left in 2024, with potentially another 100 basis points tomorrow. So we talk about what's driving the action, the rotation, and which sectors did well today, which ones didn't. That's kind of interesting moves there. And then our trade idea and the healthcare stock that's had a strong move, the kind of move we'd like to see the S&P do in order to change from what was a bearish trend for that stock to a now a new bullish trend. We'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, August 14th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. And if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I take a look at old trades, see whether we should stay in them from old videos. We also already put on today's trade that you'll hear later in the video before the market closed today. It's actually already up for us today in the brief time up to the close. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab, hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and take a look at the S&P 500 with the market forecast indicator. Take a look, see today's rally. Again, now this is a 5-day rally that we've had here to the upside. We've had plenty of these before. If you look at the daily price moves, there's your 5-day gain. We just had a 1, 2, 3, 4, 5, 6, 7-day gain in July in a row. You can see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10-day in a row right there. 10 days in a row that we rallied. Was that 10? 1, 2, 3, 4, 5, 1, 2, 3, 4, 5. Yeah. 10 days in a row that we rallied there, and 13 out of 14, this would have been in May. So we're 5 days in a row. There's another one there. There's another one there. It's not that big of a deal. It is a pretty decent gain for 5 days. Again, you look at the rate of change, and we actually need to go to 7 because that's when we came off of the low point there. Still a pretty decent sized move. Again, the only other bigger 7-day rally occurred over here. And now again, by the time we got to this point, we were above the 30-day moving average, and that's the problem. As I mentioned in last night's market outlook, we've had such a big run to get us to the 30-day moving average. Now it's an inflection point, and we have an inflection day coming up tomorrow morning with Walmart earnings and with the retail sales number, which could really throw a wrench into this rally, or it could provide us the breakaway gap we need to break out and get going to the upside, kind of like what we saw when we got that bear tag over there. We had a nice gap to the upside. The intermediate line's rising. It's now crossed above 40. So kind of like we would talk about, the near-term line needs to get above 80 in 2 days, like it did here. The intermediate line needs to get above 60 in 2 days, right? If you can see, when we go from being below 40 to above 40 at 42, then in 1, 2, took us 3 days in that particular instance to get above. We get above 60, and over here you can see we went from 2 days to get above 60 in that regard, and that's your best case scenario, is to get up there in 2 days, 2 or 3, and we can really feel a good, strong, get a bear tag, which you probably won't get a bear tag because we'll have dark green shading tomorrow instead of light green shading, as we'll cross above the 50th percentile. But still, if we can cross above 50, if we can get a good, strong day, like a good positive reaction to the retail sales number, then we can get it above 60, and then here we go, right, to the upside for a new intermediate run. Otherwise, if we have a pretty bad report and we fail and we fill in yesterday's gap, which you'll see here in a second, that's the worst case scenario, right? So that's the inflection, right? Because either we fail, and because we've got, if you notice here, we got our 5% tag. We got the 5.18, so that's set now. It can't go lower than that. It can go bigger than that, but it can't go lower than that. So if we were to falter, that 5% tag is going to be there. But again, that's how, you can see you get these kind of rallies in very small time frames that fail. And so we need to not fail this go around. Get up here, break up to the upside. Again, here's your Fibonacci retracement coming off of that Monday's low point. We are right at 62% retracement, obviously right at the 30-day moving average. We're right at resistance here on multiple levels. So, especially with the smaller ranges that we're getting, really, really important tomorrow morning before the market opens. Obviously, the strong near-term line would suggest that there's a good chance that we can break out to the upside, even with the lack of momentum line that ever got up there. You can see we're still 1/3% down. The NASDAQ 100 actually came pretty close to some of the stocks like NVIDIA. Actually, I think NVIDIA did get the bear tag today. Yeah, NVIDIA did get that bear tag. But the NASDAQ came close. It's still, the intermediate line still actually below 40, so it needs another couple of days. It's still almost 2% below the moving average. So we had a good day, finishing positive, but not good enough to really get going. The Russell 2000 started the day down and finished the day down. Started the day really underperforming, finished the day down 0.5%. So again, the intermediate line's up. It's bullish. We got light green shading. We don't have a red line yet. The intermediate line's still up, or the moving average still moving higher. But we don't have a bullish near-term high. In fact, we're set up potentially for a bearish near-term peak again, similar to the last one that we had here. So, again, it's that we're not out of the woods, as you can see from a small cap index. And if you look at the Dow Jones, it came pretty close. The moving average has already turned up, hence the no bear tag, because it's got to be light green shading and a yellow line, and the line turned green today because it moved higher. So it kind of looks similar, a little bit more similar to the S&P and the NASDAQ than it does the Russell 2000. But remember, part of the reason why it's been better because it wasn't nearly as bearish whenever we had that decline there. If you take a look at the weekly chart, you can see again the transition candle forming. It's not the strongest bullish candle, so it's not necessarily the best transition candle. You like those transitions to occur with some really good strong moves. So for example, this one over here, you can see the week of 10/30/23. If you look at the regular candle on that week, it was a good strong candle to the upside. So that's the preferred candle. As you can see right now, we have a pretty small range, relatively speaking. Remember, the high and the low shadows are the range. So it's a pretty small range for the week. It's a pretty small Haki-Nashi body, according to this differential down here at the bottom, and the PPO is actually still falling. So again, not quite out of the woods yet for what we'd like to see. If you take a look at the 3 green arrow chart, we did get, let's see here. Yeah, we did get 3 green arrows on the diamonds. That's the first one now, because the S&P is still lacking that third green arrow. Same with the Qs, and the Russell is still lacking the MACD green arrow. So we're almost there on these large cap indexes. A little further away on the small cap, and the Dow, remember, is a price weighted average, kind of doing its own thing. Looking at the 2 line, you can see the, not only is that Fibonacci retracement level there, the 30-day and the 50-day moving averages are there as well. The MACD is up above its moving average, so it's still pretty negative. It hasn't crossed above zero yet. Above zero, the stochastics is up above its moving average, but it's still not in bullish territory yet. So again, not quite the most bullish patterns. You look at the DMI, you can see it looks better, but it's not bullish, right? You're still above 25 on the negative indicator, and you're at failure levels for the positive indicator, just barely getting above 20. The RSI and CCI are similar. You're at failure levels where we can fail and roll back down on the RSI and the CCI, being barely above zero, but not up above, this 150 level, which is where you'd like it to be if we're going to be bullish. The Ichimoku cloud, we're still in the cloud. We haven't broken out yet. So again, potential for failure there if we are going to. If you look at some of these other corrections that we've had. So for an example, right there, we were in the cloud and we failed because we didn't get back above the cloud there in the correction of 2022. Looking at 2018, you can see the failure that occurred over here before we eventually went down to new lows. So, again, getting below the cloud and keeping the cloud pink, which is what we're doing right here, is not the best sign for the market. So we really need to break out, get this. Again, we're not positive on the rate of change, and we didn't go to zero on this bearish indicator yet. So we don't have a trend because we dropped below the week levels, but we also, like I said, didn't drop below zero where it pretty much ends it. So we're missing that. And then you look at the Bollinger Bands and the Keltner channels. We are in the upper half, again, but we're at failure levels, right? We need to get into the upper quartile to feel better about a change in direction. Momentum is improving, but the bands themselves aren't quite in the inside the Keltner channels yet, so we still have the green dots. We're susceptible to a renewed bearish move here from a technical standpoint. We also don't have our new 4-week high point yet. We did get a higher high, a higher low. We did close above yesterday's high point, so that's positive, all positive. Again, we're below 70 on the negative indicator on the Arun. We're at zero on the positive, so we're set up for a breakout. But you need a new 4-week high point. So we need if we can get a good gap up here tomorrow and break through like those Fibonacci levels, the moving averages, right? So a breakaway gap. If we can gap up on the Walmart and retail sales numbers and then continue to move up through the day, so and finish up ideally like a 2% type gain, then that's it, right? That is what we really like to see, because a break back down and filling in this gap and getting back into the lower half of the chart would be that, again, that failure, right? You're getting slightly up above 60 and you get back down. It's similar to other failures that we want to really try to avoid. Today's volume and trading range were really, really light. Even despite a CPI report, but I think it has more to do with what we're expected to see tomorrow. The markets, investors were unwilling to take big positions ahead of tomorrow's big reports. So you're below average on the range, below average on the volume at 42 million shares. You can see that hasn't brought the average down a whole lot yet, and we're still above that 1.5% level. You have to get back below 1% to really grab a hold of the trend and get going like we did over here. I feel really good about it. But getting back at below 1.5% at least would be a good start. And we're not quite there yet. And we'll see what kind of range we end up getting tomorrow on the news. Looking at the VIX, you can see we are way down. So, one of the biggest drops in the VIX, the biggest drop in the VIX that we've seen. If you look at the VIX on the rate of change chart, and again, we're 1, 2, 3, 4, 5, 6, 7. So you look at the 7-day rate of change for the VIX, and we are now down 58% in those 7 days. And if you go back as far back as you can, we haven't had a bigger move than that, right? You can see we just haven't had. Here in October of 1987, we were down 50% on the VIX in 7 days. But we didn't quite get down to 58. So this is by far the biggest drop in the VIX that we've seen. So let's go back to that VIX chart. The VVIX, remember, breaking 110 is a very important level, and now we have done that. So that's a very good sign for the VIX. It kind of lowers the odds of a big jump back up. We broke back below 90%. That's another good sign for the VIX. Again, lowers the odds of a big break. So the VIX is telling us we're okay, right? We're through the worst of it. We're okay, and we can lean towards, you know, a new bullish intermediate trend developing here with how low volatility has gotten again. Now let's take a look at what's driving this price action. So we'll go to our asset class comparison chart. Again, you can see over the past 3 months, real estate and bonds have been your best performing asset class. On the other hand, commodities had another down day today. So if I just look at today alone, here, so we can take a look at that. There we go, August 14th. Just drop it down to a smaller number here. So there's bonds with their biggest gain of any asset class today, which means bond yields were down again. Not too much on the 10-year yield, but you know, you can see we're at 3.82%. So down a little bit from where we were. Obviously, still in a bearish decline. We've been in a bearish decline since really since we had the failed bounce here in the end of May. Excuse me. A couple bear tags that ended up being continuation patterns, just like these bull tags ended up being continuation patterns as well. Excuse me. So obviously that means TLT has had a good day. Commodities, you can see, continue to have a really bad day, and again, that's not the best sign for like a strong bullish economic outlook, right? Have commodities breaking back down below their 8-day moving average. As mentioned before, it's going to be really hard for the S&P to really take off to the upside unless commodities do too, as kind of an idea, a reflection of growing economic growth expectations translating into increased risk appetite in the equity market. It appears the risk appetite is there for the bond market, and again, that had been pretty good. Like, you know, again, those two asset classes were positively correlated in the past, but they have not been positively correlated here lately. They've been a pretty strong negative correlation. It is coming back up to zero, and we'll see if that continues all the way back up to the upside here. But recently it's been it's been the most negatively correlated it's been for for over a year, right? If you go to like a 2-year chart, you can see it's really back in this time frame of 2023, coming right off of the banking crisis. Did we have this period where bonds fell and stocks rallied, right? And that's where we had this negative. We had a few brief instances of negative correlations, but this was the strongest negative correlation that we've seen for a while. And that's the traditional correlation, right? When you're in a deflationary environment, is for bonds and stocks to move opposite each other. But it's the commodities prices. You can see small cap stocks again really struggling down to the downside. So when you look at this is something I was looking at here, the new home starts. Let's see here, is it this one? No, it's this one. Yeah, so you can see like one of the signs of a recession is when housing starts fall on a year-over-year basis, right? That traditionally occurs before recessions occur, and you can see that all across the board. I mean, there's one instance here in the soft landing of 94, 95, where again we did not have an inverted yield curve, where we had 1 year of negative. We've had 2 years now of negative, and if you take a look at the first 6 months of this year, you can see we're already down. So unless we get a good jump into the end of this year, we're already at relatively weak levels for 2024. You can see July. We don't have the July figure quite yet, as that will come out here shortly. So that's really important, right? Because again, that's a sign of potential recession coming up, as we've seen in the past. We want to take a look at the ratio here of the Qs to IWM. So we'll pull this up again. And you can see how it broke its 30-day average today. So after being way below the 30-day average, it's really breaking back up pretty sharply. Here's the PPO for the 817. There's a long-term PPO which had turned negative. The CCI has gone up, not quite above 150, but it's gone up pretty well. The DMI is potentially crossing down here at the bottom, and then your RSI is at potential failure levels here, not quite above 60 yet. But again, you can see the big dramatic move that we've had, and that's shown up in the sector moves and how they've performed. If you take a look at the sector comparison chart, and we look at today alone here, there we go. Oops, let's switch that to a smaller time frame. So financials were your best performers today. Technology had a nice little rebound at the end of the day after being a really good performer early on, but your other two just really lagging behind. And again, when you look at the move from the peak till now, you can again see they continue to be, all three of these continue to be underperformers. And if you look at the move off of the low point, so we come over here to August the 6th, you can see technology. Now financials has kind of joined technology as another sector that's barely outperforming the market, but it's still a technology-driven market here, 8.5% when the market's up 5%, and everything else is in the 2s and the 3s. And there's your utilities and real estate that are the big winners during the decline, and still have pretty decent gains relative to other cyclical sectors, including discretionary and communication services there. When you look at that rotation, technology has jumped up. So remember how we talked about the significant low in the ratio of XLK. Utilities was significantly high, but there's that historic low down there, and then now you have finally the momentum crossing up above zero. We're not quite above the 50-day average, but your momentum is crossed above zero. And so, and again, we've seen it cycle through when you're below the 50-day moving average. And so that's kind of, we're likely to do that because it's hard to make such a run from such low levels up to high levels on the relative strength. Again, when you're this far below the moving average, it takes a lot of energy to get up to this point. The breadth wasn't too bad. We got right on the 300 mark exactly. So that's that 60% level, very important level, still below the moving average, but very important level there. The new highs and new lows, you can see, did turn positive, again, just barely, and still below its moving average. Needs to get above that positive 100 level for us to feel really good about it. And then our McClellan oscillator was also positive today, but again, not above 35, still at pretty low levels. So, positive signs all across the board, but not really, positive enough breadth yet to achieve escape velocity that you need to change the trend from, this bearish intermediate trend we've been on to now a new dark green period of dark green shading and a green line. And again, you continue to see that, we're not quite getting the money flow that's needed to get going. We're above 50 on the oscillator, not quite above, not into bullish territory yet, but we need to really break up and another indicator similar to this that we talked about in our technical analysis class today. I kind of broke this indicator down, but we're not, the force index on a 13-day basis, not above zero yet, despite the strong rally we've had. But again, over however many days it's been, it was just this 2-day or 3-day decline was just as significant to the downside as this 7-day rally has been to the upside. In fact, more, because we're down more. We're not back above zero yet. So it kind of goes to show, the kind of move that we've have, and putting it into context of other moves, not just on its own on an absolute basis. This brings us to our trade idea of the day on Eli Lilly. So let's take a look here at Eli Lilly. Bear with me 1 second while I do that. Here we go. So looks very, It looks very similar to the S&P because it is the S&P. Let's pull it up here. There we go. So, nice, good, strong move. Dark green shading and a green line. Intermediate line is almost about to cross above the market sentiment. It has gone from below 40 to above 60 in just a couple of days. The near-term line at strong levels. We're 7% above the moving average. I mean, all that's looking really good. We've had a bear tag, and we're building on that bear tag. We have a good, strong, bullish candle here. Eventually, why it doesn't show up. Try that again. Good, strong, bullish candle after a good transition candle last week, and you can see this transition was a good, strong, bullish candle last week. The kind that we like to see. So that's looking really good, right? You look at the 3 green arrow chart, and obviously you have 3 green arrows. You have good volume too on the 3 green arrow, the actual 3 green arrow signal. When you look at the 2-line version of the chart, we are looking really positive. Eventually, there we go. So we're breaking above the 30-day average. The 8-day is clearly above its 17. You can see the strong momentum and the MACD being pretty high. Almost about to cross the 30, both the 8 and 17-day are. The stochastic's up into its reversal zone, so very good, strong move there. Looking at some of these other oscillators, looking at the DMI, you have crossed the positive, has crossed up above the negative. The negative isn't quite below 20 yet, but the positive is clearly above 30, so that's a good sign. Your RSI and your CCI are at bullish levels, above 60 on the RSI. We got above 150 yesterday on the CCI. Looking at the Ichimoku cloud, we're flirting. We are actually above the cloud. We are flirting with an intermediate trend strength down here, being above 2 and above 65. And then you look at like the Bollinger Bands and the Keltner channels, and we are in the upper quartile of the bandwidth. Clearly in the upper at the 91st percentile. Pretty strong bandwidth too, above the value area, pushing up against the upper Keltner channel. Good change in momentum from pretty strongly negative to now pretty clearly positive. So things are moving in the right direction for the stock. So what I decided to do is do a directional trade, selling at that mid-30s delta. So selling the 970, buying the 960. We got in for, I don't know how much did we end up getting in for, about $3.40. Yeah, so just one contract because that's within our $500 limit for a directional trade. But getting a pretty decent return, almost 2 to 1. But obviously, I mean, it's a relatively high probability directional trade, so we're not getting a whole lot of reward for that risk. But we got a lot of flexibility, and when I consider this relative to like a bull put spread, we're getting double the reward that we would for about a third of the risk. So that's the kind of higher probability trade I like to make, a little bit more directional, and again less risk than what we would take, say, on a bull put spread here. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.